Welcome back, navigators. In this video, we'll see some practical guidance and tools to assess your own risk tolerance, considering factors such as financial goals, time horizon, and personal comfort with risk. Have you ever asked yourselves how to determine your risk tolerance when investing? It's a question many investors grapple with. Risk tolerance is essentially the degree of variability in investment returns that you, as an investor, can comfortably endure. It's a personal attribute unique to each individual and is shaped by various factors. Your financial goals, for instance, play a pivotal role. Saving for a vacation might allow for more risk than, say, saving for retirement. Your time horizon is another key influencer. The more time you have, which means the younger you start investing, the more risk you can afford to take, as market downturns can be offset by future upturns. Then there's your personal comfort with risk. Some of us are thrill seekers, embracing the roller coaster ride of the stock market, while others prefer the steady, predictable path of bonds or bank deposits, lower returns. Recognizing your risk tolerance is the first step to making informed investment decisions. But how can you accurately assess it? Consider Emily, a 50-year-old who plans to retire in 10 years. She's not comfortable with the idea of losing any of her hard-earned savings. Emily is the epitome of a conservative investor. Her priority? Preserving capital and generating a steady income. She achieves this by focusing on low-risk investments, such as bonds and mutual funds. These instruments, while not known for their impressive returns, provide Emily with the security she seeks. They are predictable, stable, and less likely to fluctuate wildly in value. However, it's not all sunshine and roses. Emily's conservative strategy means she might miss out on potentially greater returns from higher-risk investments, but that's a trade-off she's willing to make. After all, her goal isn't to become a millionaire overnight, but to retire comfortably without the fear of outliving her savings. But what about investors who can stomach more risk? Meet Robert, a 30-year-old with a long-term investment horizon. He's comfortable taking on higher risk for potentially higher returns. Robert's portfolio is a testament to his high-risk tolerance. His investments lean heavily on stocks and cryptocurrencies, assets known for their volatility. While the thought of such a portfolio might make some shudder, for Robert, it's a thrilling ride. He's banking on the long-term potential of these assets, willing to withstand short-term fluctuations for a chance at substantial profits. Consider the year 2023, when a tech stock in his portfolio skyrocketed, multiplying his investment several-fold, or the time his cryptocurrency holdings surged, bringing him significant returns. But it hasn't always been sunny. There were years when the stock market plummeted and his portfolio value took a large hit. Yet, Robert remains undeterred. He's in it for the long haul and he understands the risks involved. Robert's aggressive approach matches his high-risk tolerance. But what if you fall somewhere in between? Most investors aren't strictly conservative or aggressive. They fall somewhere in between, like our friend Lisa. Lisa's investment journey is a blend of caution and courage. She's not one to put all her eggs in one basket or to shy away from a promising venture. Instead, she opts for a well-rounded investment strategy, a mix of low-risk and high-risk assets. Think of it as a financial seesaw. On one side, she has safe, steady assets like bonds that provide a reliable, albeit slower return. On the other side, she has higher risk assets like stocks, which are more volatile but offer the potential for significant growth. This is the essence of diversification. It's about how you allocate funds, creating a balance that aligns with your comfort level with risk, your financial goals, and your time horizon. Lisa's balanced approach reflects her moderate risk tolerance. So, how can you find your own investing balance? Determining your risk tolerance isn't an exact science, but there are practical steps you can take. Start by setting clear financial goals. Are you saving for a rainy day, a new home, or perhaps your retirement? Your goal will guide your investment decisions. Next, consider your investment time horizon. If you have years or even decades before you need to cash in your investments, you might be able to tolerate more risk. Then assess your comfort level with risk. Many financial institutions and online platforms offer risk tolerance questionnaires. These surveys typically ask a series of questions about your financial situation, investment goals, time horizon and comfort level with market fluctuations. Answer these questions honestly to get a sense of your risk tolerance profile. And if you're still unsure, don't hesitate to seek professional advice and get valuable insights tailored to your situation. But keep in mind that understanding your risk tolerance is key to investing with confidence. That's all for today. Until next time, take good care of your finances, navigators, and don't forget to subscribe and share if you found any value.